Hit it.
It's Friday, August 14th, 2026, episode 298. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show StoneX's Vincent Deluard. Vincent is just back from Japan, and he's got a couple of new trades for us, including one that has Europe and Japan swapping places. You don't want to miss this. And then we're back to normal with my favorite technical analyst grabbing a mouthful of crayons and telling us what he sees in Patrick's talking charts.
All right, well, Kev, I'm going to have a beer while watching this. I've got the Murmurio. It's an American amber ale made out here in Portugal. So
what's with you and these American beers made in Portugal? I think that's the second one.
Why do you always drink Indian Pale Ale? It's made in India. All right, let's do the disclaimer and get to the interview.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include inflation relief dependency, payroll performance dysfunction. Older men get that. And the copper conviction contagion.
I have a bit of that. All right, let's get to the interview.
All right, it's my great pleasure to welcome back to the show a fan favorite. And I know I say that a lot, but I truly mean it with Vincent. Everyone, when I go places, Vincent, everyone always says, oh, you got to get that Vincent guy, that French guy back. He's just so much fun. It's Vincent Deluard from StoneX. Thanks for making time for us, buddy.
Super happy to be here and right back at you, buddy.
All right, so let's start with Japan. And now you were recently in Japan with your family. But I love this quote that you started one of your pieces recently with. It's like, and it's from Lost in Translation, that great movie with Scarlett Johansson and Bill Murray. Was that right? Yeah, I think I got it right. You guys says there are two types of foreigners in Japan. Those who have been here for 1 week and understand everything, and those who have been here for 10 years and understand nothing. That was just great. Tell us, you were there for probably more than a week. Do you understand everything yet?
Yeah, I definitely belong in the former category. The stupid white guy who's gone to Japan for 2 weeks and, can't stop talking about it and boring his friends about, how much it's better over there, So with that caveat, yes, I was there for a little over 2 weeks. We were my two boys traveling around. We hiked up Mount Fuji and it was a blast, and I think I got some insights that are somewhat interesting. I also think it was kind of interesting for me to travel there as a European, because I got this impression that Japan is the road not taken for Europe. I feel like 25 years ago, that Europe and Japan could have ended up in very similar position, and Japan made different choices, which I think are better. And maybe there was a bit of luck. I think the depreciation of the yen played a lot, but I think after 25 years, you can really see the different outcomes. And there was a little bit of almost envy or nostalgia when I thought of like what Europe could have been, and what Japan is.
Well, let's explore that, because I think a lot of people have this image that Japan's not doing well. Like, you have the kind of St. Bart's crew that are calling for 250, USD GPY as they collapse into this demographic, stew of despair. And then we have guys like you that are like looking at this and saying, look, actually things are going well. And why don't you first address how much they've devalued their currency over the time, and then explain what you mean when you say that Europe could have been like Japan. And I think that people might hear that and not really appreciate that you're very much saying that Japan is doing a lot of things right.
Yes, absolutely. So I think we have to start with the currency, because I don't think there's a precedent in a G-free economy with floating rates where we've allowed a currency. So I remember, I think it was after the earthquake and the tsunami, on promise of the fiscal stimulus. I think the yen was at about 85, 90 against the dollar.
Yeah. I think it had a 7 handle at one point.
7 handle? Okay. Yeah,
I think, yes, it went to 79 or something. It was way down there.
So when I was there, and after the intervention came back, but it touched 164. So we are talking a halving in nominal terms. And then if you adjust for inflation differentials, The fact that, even after the spike of inflation, Japan's inflation has always consistently been 1 to 2% less than that of the US. I mean, you're talking a 75% devaluation in real term of a major currency. Now, you could argue that the yen was surely overvalued, but I
Yeah.
mean, this is insane. Like, this is really insane. And that will fix a lot of things.
Yeah.
It will take care of a lot of problems. So I think that is the primary, that's kind of the elephant in the room whenever we talk about Japan.
Yeah.
And I mean, I'm happy to talk about more about what we see, but I want to go to the latter part of your question. Um, yeah, I'm not, on the JPY 250 and fiscal dominance and that dynamic create insanity. I mean, if you really want to do that, I mean, look at France, look at England, look at look at the US. But like
Yeah.
Japan, I mean, objectively speaking, I think they have a small primary balance. X interest, it's even surplus or it's balanced.
Right.
Run the same number in France, run the same number in the US. If you look at net debt to GDP, so you net out the government held and central bank held debt from
Right.
the stock of debt, because it's basically a liability on yourself. It's been going down by like 25% of GDP over the past 5 years. I can't think of any single country that's achieved as much public sector deleveraging as Japan. And then the last part, which really stunned me, is in the US, I'm a big tax collection guy, right? So
Oh yeah.
I think it's been super helpful, keeps being helpful. And the great thing about Japan is also they have like this great data availability. And now that we have the fancy LLM, you don't need to speak Japanese. You can just say, hey, can you find it? So I found the tax collections in Japan, and I found that tax collections in Japan have been growing by 6-7% a year for a couple of years now. So and the deficit is not that bad. There are these massive piles of foreign assets on which they earn a lot of money. So I am not at all on that, fiscal train wreck. And I think the people who are most vocal about it are the one who know even, so at least I've spent 2 weeks in Japan. Like that makes me an expert compared to 99% of the Twitter crowd that talks about this stuff.
I saw something the other day. It's not just net debt of the central bank. It's, I believe, when you do debt as a percent of GDP, Japan has actually been decreasing over the last 10 years or 5 years at least.
Yeah.
I think Bloomberg had a piece in recently about that. So we're seeing that. And what do you mean when you talk about Europe and what Europe could have been, and you're contrasting Japan to Europe? Tell me about that analogy.
Yeah, I think the let's start with the similar points, right? If we start in late 90s, early 2000s, and at the time, I think the trade was to be on Europe, right? Japan was this kind of deadbeat economy, also had their bubble in 89, couldn't come out of it, stuck in deflation, balance sheet recession, and then facing a very grim demographic future. And in that sense, Europe and Japan were quite similar, right? I mean, Europe was also slowly aging, kind of missed the tech revolution and all of these things. But still in 2000, objectively, you would have thought Europe was going to do a lot better. They were, integrating, building the common market, expanding east. And the reality is you look at, 25 years later, I would argue that life has gotten better in Japan, and it's gotten significantly worse in Europe. And I would think it boils down, I would think it boils down to generational choices and the way Europe and Japan have handled this demographic crisis has been completely different. Japan has actually allowed pain on its older generation. I mean, if you go to the stores in Japan, you'll see, 75, 80-year-old work. Now, maybe it's the Japanese work ethic and they like to do it, or I don't know, but I think pension payments in Japan as a share of GDP have not gone up, even though the proportion of older people has gone up. Okay. They've allowed housing prices to come down. I mean, I'm sure you've heard reports of this. There's plenty of websites where you can buy a house for 1 yen. I thought about it, and then finally they allowed the currency to depreciate massively, which is a way to that's the most, again, that's why I go back to this currency argument. That's the most powerful force. If you devalue the currency in real time by 80%, instead of having boomers taking a cruise in Thailand, like what's happening in France,
Right.
because the euro is a bit overvalued, or in the US, and at the same time you're losing your manufacturing base and you have a very high youth unemployment rate. So strong currency is effectively a transfer from the young, the poor, and the working to the old and idle. And in Japan, the falling currency is the exact opposite, right? The Japanese boomers, by the way, I still think they're fine. Like in Japan, life costs nothing, like
Yeah.
you go to the convenience store. I mean, you can eat for really just a couple dollars. So they're still fine. I mean, just if they go abroad, they get, but, do we, as a society, do we have a duty to provide, repeated cruise vacation to our elderly when we have the demographic profile of Japan and Europe? I don't think so. And this weak currency has allowed Japan to maintain a very large manufacturing base. I mean, you see that even if you travel across Japan. One thing that struck me is there's still industry, even in small towns. There's industry, there's farming. It's not like, you go to a lot of European cities, right? You have like the big metropolis, like Paris. There you have your services, you have some industry, but outside it's just like tourism and government. Like there's not much left. While Japan maintain this kind of beautiful economic balance on its territory.
Okay. So when you're thinking about how to take advantage of this, one of the things is that you're explaining why it's so good for them to have a low currency. Why is that going to change? And what's the best way to take advantage of this cheap Japanese assets?
Well, I don't know that it's going to change right away, but I think the risks have increased so much that it would be kind of the proverbial picking dime in front of the steamroller, right?
Right.
The first immediate thing we can think of is the currency, the interventions, right? I mean, we saw the last week. I mean, we can talk about how gloriously ironic it was to see Besant, who made a fortune betting against currency intervention, do one, and then with a note, like
Yeah.
remember to buy 20 KPY.
Like buy some milk, some butter, and sell 10 yards of yen.
And he put the ticket just in case.
Yeah.
And doing it against the euro to get I mean, it's insane that we have like the treasuries run like a hedge fund. I mean, we truly live in extraordinary times. So there's the intervention, right? I mean, and then the bearish case is that, well, they always do that, and then just wait 6 months, and the dynamic are gonna flip it back. Now, I would take the other side of that trade, even though I think it can continue, but again, it's all a matter of balancing the risk, right? What's the main driver of the secular depreciation of the yen? It's the rates differential, right? At the end of the day, you could get free money in Japan, and you could just play the carry trade with, any Asian, Mexican real, peso, Brazilian real, whatever. So there's massive short built on the yen, which of course is a risk, because the moment it cracks, it spins back up. But that rate differential has been shrinking. I mean, you look at the long end. I mean, the 30-year JGB yield, I think, is one of the most shocking charts you can look at. I mean, just straight up, like it's close to 4% now. So on the long end, we've done like 95% of the way. Now you could argue on the short end, it's not there yet. Like the Bank of Japan has been kind of slow, but it's still closing. I mean, I'm not very bullish on rates in the US. I think Walsh is kind of full of it. I think the market kind of overestimates the extent to which Walsh will raise rate, if at all. And conversely, in Japan, because there's all these narrative about the fiscal dominance and the debt dynamic, which I think are false. Like the Bank of Japan can hike rates. Nothing bad is going to happen. So
in fact, things might actually be positive, because then Japanese might bring money back into Japan. Right. We might find that it is actually positive for financial assets for them to raise rates.
Correct. I mean, because all these foreign assets what a trade, that they bought all these treasuries. They have what the largest holders of treasuries, right? I mean, by official, just in the reserve, like there's 1.2 trillion in there. They probably bought that at like 80. Like that. What a trade, what? And I think that my understanding is they kind of kept that in dollar, kind of compounding. Like it's so. so I think they can raise rates. I think the also another major driver of this secular downturn of the yen was changes in the asset allocation of the pension fund sector. So
Right.
that was kind of part of the three arrows under Abe. Basically structural reform, cheap yen, and QE, and the way you would cheapen the yen was by telling your insurers, your pension funds, hey, just buy foreign stuff. And you can see that, for example, GIPF, Japanese Government Pension Fund, used to be domestically oriented, and then after 10 years of Abenomics, now it's 25 domestic equities, 25 foreign equities, 25 domestic bond, 25 foreign bonds. So huge increase in the holdings of foreign equities and foreign bonds, and of course that weakens the yen. That means that they have a huge capital gains on this position, and now the argument that the new prime minister has repeatedly said is we want to bring the money back.
Right.
So you really, I mean, no matter where you look at, whatever your theory of exchange rates is it about purchasing power parity? Japan is massively overvalued. Is it about rate differential? They're closing. Is it about flows? They're moving the other way. Is it about, politics? Like I do think there's a shift in the political vibe. I think the US was kind of happy to have this weak yen. Because we kind of wanted to give Japan a little bit of breathing air. They suffered for 30 years. They had the earthquake. Also, they're strategically important, and it was annoying China. Right? I mean, the weak yen was a way to put a stone in the shoes of Xi Jinping. Now it's gone too far. So even the politics, I think, are turning again. So it's hard for me to find a convincing bearish argument for the yen, and not one that is not kind of the stuff we've been hearing for 25
Right.
years about the debt.
Well, I think the fact that people are calling for 250 and getting greedy about their calls after they've been right, and just, that one guy had it at 200, started to get close. He's like 250. I'm like, dude, like take a victory lap and just ring the register on the trade. Okay. You mentioned something that I thought was really interesting. And I think a fact that a lot of people too often forget. And you said something to the effect of, you want to talk about problems with the fiscal, we should talk about the US, France, the UK. And that to me is one of the other things that people just keep forgetting about Japan is they're the ones with the capital. Like they're the ones with the money. Go figure out who is borrowing from who. And it's Japan is the one lending to everyone else. So you mentioned France. Let's start there, because I think that you've been writing some pieces recently about the problems in France, and you're a real European bear. So let's hear it, because I thought this was a really interesting kind of trade idea.
Well, thank you, and I think, by the way, it plays nicely with the yen story. I mean, one thing that could come out of it, I think, is a short
Euro yen.
Yeah,
Just like Besant.
Yeah. Yes. do like the pros, But I think there's more meat to that. I mean, I think we can come back later but first let me start the French situation. I think France has been quite lucky. Like it's been the bad student that gets put in the group with a good nerd, and no one asks them to do much. Everybody knows he's a problem, but he's kind of friendly, and but we've been doing that for a long time, and I think we're at the end of our ropes here. So the fiscal has been awful. I mean, with the exception of the US, and I think the UK actually is starting to address the problem. So I think really the two problem children for fiscal are France and the US, but the US is the world hegemon and issues its own currency. France is a foreign great powers with, who can't print euros. So that's a bit worse. So the fiscal has been terrible for many, many, many years. We are, if you want to do like the debt dynamic, right? It's all about R minus G at the end of the day, right? And R is how much you pay on the debt. G is how quickly your economy is going, right? And if that gap is positive and you keep running primary deficit, your debt snowballs. That's France. Okay. France runs big primary deficit. R, if you look at the 10-year OAT, now of course the weighted average cost on French debt is not 4% yet, because we issued a lot cheap, but it's like a magnet, right? The more time passes, the more it gets pulled toward that 4% that we pay on the 10-year OAT, and at the same time, nominal growth is not 4%. We actually have very little inflation in France, and to the extent that we have inflation, is coming from commodities, which is not great. So if inflation is around 1%, real GDP growth is I would say less than 1. So we have a gap there, and we have a primary deficit, and we have we're deficit country, so we need foreigners to buy our stuff. The Japanese have done a good job at that, but I think it's going to be increasingly hard. And then on top of that, and that I don't know if you want me to get into French politics, but
sure, let's do it. Yeah,
okay.
No, give us some French politics.
I think there's incredible complacency about the rise of populism in France. So basically, the French political system has excluded the extreme, which I think is a big mistake. I mean, you can't run a democracy by saying 50% of the people are idiots and we should not even talk to them. But we've always kind of set it up so that, the far left is awful, the far right is a bunch of fascists. And we keep doing that every election, and every election the middle gets smaller and smaller because the middle keeps making stupid mistakes, right? I mean, everything that Europe's done in the past 25 years has been horrible. So yeah, over time, the ranks of the disgruntled grow.
Okay. Can I interrupt here, because you had this line in your post that I was going to address, and this is a good time to address it. You say the social media following of the main contenders and France legacy parties is embarrassingly low. The two likeliest centrist candidates, Giatal and E. Philippe, have fewer followers than the average OnlyFans foot models. I don't know if that's right. You should be aware that there's a lot of people on OnlyFans foots.
That's my point. I'm saying, like, if you just have like average foot on OnlyFans, you probably are more popular than the person who's supposedly going to win the French election. So the consensus is that these guys are going to win. They're going to face off Marine Le Pen, who is the far right candidate. Okay. And, she's lost. She's the forefront. She's lost 3 times everywhere. Everybody's basically thinking, all I got to do is get in second, behind her. And then we can do the whole joke about fascism and blah, blah, blah. And, we do the Spanish Civil War all over again. I don't think it really works, but, it's worked in the past. So they all think they only have to be second. What they do not see is, to me, this train that's coming at them at increasing speed is the hard left in France. Jean-Luc Mélenchon, La France Insoumise. This is a guy who speaks extraordinarily well, is legit crazy on some economic issues, goes in public. What's your plan to solve the deficit? His plan is to default on the debt. Like, we're not going to pay interest. Like, and I can see how, like, when these guys are 25% of the poll in March, you'll be nonstop on the French business network. They will play clips of that, of him, like,
So wait, can I just understand this correctly? The leading left candidate has openly said his solution to solving the debt,
yes,
or the deficit, is to not pay interest.
Which mathematically it works. That's our logic.
You can't argue with the math, right? You can't argue with the math. Oh gosh. Okay, keep going. So
this guy is the only talented guy who's running in the French election so far. His base historically is Muslims and kind of disgruntled, highly educated, kind of like the way like the Fox caricatures your DSA, like urban, went to college, that shops at Whole Foods. Right. So but doesn't make a lot of money and wants the government to give them a job. That's kind of his base. Now, structurally, these two bases are growing very rapidly, right? Just because of immigration and differentiated mentality, the Muslim population, and he has like scores of like African presidents with the Muslims. Like, it's like in some towns he gets like 90% plus of the vote. Okay. And then the disgruntled young French workers are growing very rapidly because the French economy has not created any jobs. It's run solely for the benefit of the boomers. The corruption of the La Casta, like the elite, is so the two are growing. Last election, he was like 10,000 votes away from qualifying. I mean, he's already pulling double to where he was. So I think there's incredible complacency. And then, yeah, he'll qualify for the second round. And now that's where you get the second round, where you have Marine Le Pen of Rassemblement National, who the idea is that she's going to do a Meloni, where you run, you try to be a populist, but eventually you negotiate with the European Commission, and you end up being okay. You just tighten the border, and I think it's broadly correct, but I also don't think she's as smart as Meloni.
Okay.
And I still think it would be bearish for Eurozone assets, French government bonds, and the euro if she won, because, yeah, there's kind of a skill gap there.
In essence, the reality is that the market's assuming the middle is going to win, and the middle is not.
Yeah, the middle is not even going to be there. So it's going to be
Right.
your best option is going to be someone who they spend their entire life saying that she's a fascist and she'll do, gas chambers, and that's going to be your best option, because the other guy on the left just runs on, let's default on the debt, and then that risk is not priced. Like if you look at
And
sorry.
so I'm sorry to interrupt. When is the election? Like what would be the timing of this? Like when will the market start to figure this out?
Right. So the election is in April. 2 rounds is going to be a 2-week period in the middle. I think the point of maximum vulnerability will be fall, winter, spring. Right now they're still trying that kind of middle ground of mediocre candidates is still trying to fight it out. No one is really emerging. So I think we still have a couple more months before the market starts to worry. Also, people are not thinking about the election so much. Like, I mean, I don't know if you know, but like France has been heat wave after heat wave. I mean, it's hard to just survive in France at this point. You have these fires and these massive heat waves. So I don't think people's heads are there. But usually this is what we call la rentrée sociale in France. So the vacations are,
yeah,
we're gone, right? We're gone July, August. So what we like to do when we come back from vacation is to go on strike.
Oh, I'm glad we got a Frenchman that can say all these things, so it's fun. Okay, so what's the trade then? I guess you can short both the stock market and the bonds, like to play the German Bund spread.
Yeah. So traditionally, I mean, for past couple of years, I've recommended the BTP OAT because I see things getting better in Italy and worse in France, and
okay.
And it worked really, really well. Now to the point where on some days, French debt Italian debt trades inside French debt. Like yields in Italy are lower than France, which would have been unthinkable a couple of years back. Now I'm a bit less. I still think generally Italy is on a better trajectory than France, but the market appreciates that better. Meloni, she's been there for what seems like an eternity by Italian politics. So I would just go back to the good old just spread trade. You do it against a German. Not that I'm any bullish on Germany at all. I think that German models are equally broken. German politics are equally broken. But if it's what I think it is, which is like a just sovereign crisis, the flight to safety is gonna kick in. So yeah, I would do that with a Bund, and then also I think with the yen. One issue, and I remember we talked about it. I think the last time I was there was we've been selling a lot of French debt to the Japanese. Japanese used to love French debt, right? Because it used to be AAA and they're very conservative, but that little 30 bips you'd have over the Bund, like for Japan that were starved for yield, that was like properly high yield.
Right.
So they love the French, and the French I have friends at the Agence France Trésor. I mean, that was the highlight of their life, the trip to Japan, like go sell to them. So, and again, if we think about this, the GPIF, the pension fund, government pension fund in Japan, you look at your asset mix. I mean, you want to rebalance domestically, right? But, Trump doesn't want you to sell treasuries. I mean, I don't believe that's true, but there's these rumors that, they intervened to prop up the yen because they were afraid the Japanese would sell treasuries. I don't really buy that, but I think it does show that, that you have to hold on to U.S. assets.
Right.
So if you hold on to U.S. assets, the only pie you can take from, by definition, is going to be non-U.S. international assets, and I would think French bonds are a good chunk of that.
And that also plays into your short the euro versus the yen as well.
Yeah, I actually like that trade a lot for a lot of reasons, but that would be one of them. The flows. I don't think that the U.S. will allow Japan to repatriate their holdings of U.S. assets. So if we want to buy more Japanese assets, you kind of have to take it from Europe.
Right. One of the things that you mentioned there is the U.S. and I have to give you credit. I turned bearish, and I remember you reaching out and saying, you make a lot of sense, but I'm not quite there yet. I think that the fiscal is still that, sail in the back of him pushing the economy more forward. Recently, you've kind of, played that out. You did a terrific trade. You were more bullish, and you're kind of slowly backing away from that. What's driving that? What do you see? What are you worried about?
Well, thank you for the kind of words. And I mean, it's hard for me because I've been the nominal growth bull for 5 years, no recession, fiscal, it drives everything. And I think I'm really changing gear. Like I'm turning into not necessarily a recessionista, but certainly a bear on the equity market. I'm like, there's a graveyard of them out there. Do I really want to have my my head? But I do. Yeah. I think the U.S. economy.
There's more and more going the other way, though. Guys giving up on the being a bear and moving in. Like, just think about it. There's a very famous bond bull that turned into a bear. Like, what's the world coming to, right? Like, we're
no, I'm gonna say it. I think the market overestimates hikes, and long-term treasury yields are attractive. I mean,
I'm with you too. I feel dirty when I say it.
I know.
Okay, but in all seriousness, so I was saying that thing about you staying bullish, and you did. I remember because I got more bearish, and you're like, I don't think we're there yet, and you kept talking about you saw the tax receipts. Right. That was your big driver, and kudos to you because that really was the signal that it was sent, and it was stronger than I thought it was, and it didn't roll over. But one of the things that I was thinking about when I was preparing for this interview was that we've been talking about fiscal and how important it is for a long time. And we think about the one big, beautiful bill. And if you step back and think about kind of it, not just in like month to month or even quarter to quarter, but go to year, it was all front loaded to basically be ending right in front of the midterm. And on the other side of the midterm, this all goes into contraction.
Yeah. Well, that's it. I mean, so two things. So first, you mentioned the tax collections. So this is I watch this like a hawk. Okay, and I'm not ringing the bell yet, but it's certainly flashing orange. So we had this, and I remember we talked about this, right? In February, we're looking at 10% growth in personal withheld employment tax. 10%. I mean, it's stunning. Like, wow, we cut taxes and we get more money. Like, this is Arthur Lather on steroids. And I didn't have a good read. I mean, it was insane. It's slow. Now we're looking at 5. Now you can argue 5% when you have zero labor force growth and a major tax cut before, it's still pretty good. So that's why I'm not turning full recessionista. I think I'm kind of turning stagflationista, if you will.
Okay.
But it is slowing, and I think it's going to slow more. Exactly your point on fiscal. I think that Trump likes to talk like he's some sort of maverick, but the stance of fiscal has been exactly what your political cycle theorists would have said, right? So we tried to do the hard stuff the first few months, right? Doge, and that blew up, the tariffs. So we had some sort of fiscal contraction, less spending and more taxing, which is what tariffs are, in the first year. And then the stance of fiscal policy switched this year, right? So one big beautiful. So let me just run through the number, and I think that helps, especially when we think about this earnings growth in the U.S. stock market. Okay. Right. So we had about $100 billion in tax refunds extra compared to last year, and that was spent right away, right? Because this hit right when we had the Iran war, and this is why you pay more for gasoline, but you got $1,000 more. I mean, so that was like a straight shoot of adrenaline in the arm. Okay. Then we have the tariffs. The DHS is actually sending money net because the new tariffs are lower, right? We have this 10% compared to the IEPA. And then we have to repay the old tariffs. So for the month of May and June, DHS sent something like $100 billion to like Walmart, Target, and all of that, right? So that's a form of money leaving the public to the private sector. Then there is this massive capex boom, which is happening at the same time as we have the 100% depreciation rule. So if you look at corporate income tax collection, they should be $100 billion higher, but because of that massive loophole, where if you do all your capex now, you can write it off this year, you against your taxes.
Right.
That's my, and then you add in the SPR release, we had, close to 350 billion in stimulus that hit in sequence, right? It was first the tax reform, then the tariffs, and then the corporate income tax is kind of quarterly thing. And as you point out, if I look forward, it's gone. Like, we're not going to have a one big beautiful bill again, right? I mean, it's the impulse, it's gone. The tariffs, if anything, I think is going to switch back, right? Because we're going to have now it's fully reimbursed. I'm sure Trump is going to throw some new tariffs, because that's going to be, if I'm right that the Democrats are going to sweep everything, that's the only thing he can do. And because he's like a child with a hammer, everything looks like a nail to him. So I think the tariffs will be back on. And then the capex story might still keep going, but in terms of impulse, it's just not going to be there. Now, you can argue that maybe the fiscal is going to come from military spending. We have about a $500 billion increase in military spending in the plan, so that's 2% of GDP. That's significant. My concern is that it's not going to go through. Right, we're losing the war in Iran. The Democrats are going to win it, and he's just going to be stuck there. And even if he doesn't get stuck there, it's going to take some time to kick in like this. So at least there is a gap, between now and January, when the new budget kicks in, where there's little stimulus, and that's that. I see the tax collections kind of rolling over. I see the kind of middle class getting squeezed, the low job numbers. I could see the economy finally slowing.
You mentioned you don't think that Warsh is going to hike and might actually be cutting. And I understand, I suspect that it's kind of tied to your view about the economy rolling over. But let's just play a game for a second and assume that the AI bulls are correct and that this transformational technology will continue and the AI spend out might even increase. Like we saw those guys, $500 billion on CNBC, the round table of all the guys there talking about $500 billion of spending, which is just insane. But let's just imagine that the private sector steps up through AI and continues this going along. And what happens, do you think, if we get a situation where unemployment, the employment market tightens, meaning the jobs get even better, and inflation goes back up because, oil doesn't go down and the economy picks up? Will Warsh be forced to tighten? And does the market even care anymore?
Yeah, I think in this case he would hike. I think he would like to hike because.
You think he would like to hike?
I think so. I think he wants to be cute. I mean, he doesn't really want it, but I think he wants to regain credibility and then get some. He's not happy with his performance, so I think there's probably a part of him that just would like to throw in. So if he gets an excuse, I think he would do it. Now I just don't think he's going to get that excuse. But
okay, fair enough. I understand that argument. But you think there's a little part of him that actually wants to hike and show how tough he is.
Yeah.
Like a little bit of a macho. Like I'm not Trump's puppet. I can actually hike.
Like, yeah, and he'd like to surprise markets too,
But then why not hike last meeting? I know, and listen, I understand. He's just one guy on a committee of whatever. Mm-hmm. So, but I still assume that it felt like he had switched back. Like, to me, it felt like he did all this hawkish talk, and then was like, whoa, actually, I didn't want that as much as I thought I wanted it. And he was like, and he's all over the map. And it's, I shouldn't really be surprised, because if we remember back to like like I still go on and on about this, but in 2018, I remember at the beginning of 2018, him and Stanley Druckenmiller were writing op-eds about
Right.
how what idiots the Fed were and how they had to crank rates. And then within, 6 months, when the market rolled over, they started writing op-eds the other way, saying that the Fed didn't understand how bad things were and they had to, like cut rates by huge amounts. So the reality is, I think he chases the economy more than most other Fed governors. He's more like a trader's Fed than he is an economist Fed.
Yeah, I think that's right. And that adds a level to risk. I mean, which is why, if you ask me, like over the long term, I would take the under. I think the Fed cannot hike, won't hike. I believe fiscal dominance, and he was put there, but because of his personality, because of his ideology, because of his ego, honestly, I think there is a risk of little like policy mistakes where you just hike and then you have to cut. Now, why didn't hike last time? I mean, probably because I think he was right not to do it because the data came in somewhat soft, right? Inflation data was a nothing burger. The job numbers were soft. We also have the seasonal stuff, right? The World Cup is over. It was probably not the time to hike. In general, the Fed kind of likes to wait after Jackson Hole, and that's been the pattern of prior Fed chairperson, and so he's honestly, I think he was right not to hike.
I hear you. I completely agree. I was just surprised to hear you say that he wanted to hike. That was just interesting. And I'm not going to push back. I think the little part of him does want to be all tough with the market and show them that he's not Trump's puppet. And let's not forget, he's there for what, 7 years, 9 years? I can't remember what the number is, but 2 of those are Trump. There's going to be another 5 with another president. He doesn't want to throw away his career on, doing Trump's bidding. And I think too often people forget that.
Yeah, that's a very good point.
All right. So how does the US dollar, so you're bullish on the US dollar or bearish on the US dollar against the yen, bullish on it against the euro. Is it really not like, does the US dollar go somewhere as a whole, or is it going to be a bunch of individual currencies?
Yeah, so I'm going to answer. I think the correct answer is euro yen, right?
Yeah.
So,
what about like the real? What about like the Canadian dollar? Is there a trend in the US dollar in the years, like in the coming quarters and maybe year? Like, does it sell off against everyone except the euro? Or
that would be my guess. I think the U.S. economy is slowing. The war that we are losing, just a matter of accepting the terms of the defeat. That's got to be dollar bearish, right? I mean, you lose all your allies in the Middle East. You lose control of the most strategic region in the world. That has to be dollar bearish. I think we have a massively overvalued stock market. There's still risks of foreigners repatriating. So, long term, I'm still kind of at lower dollar camp. Now the problem is it's the same thing with fiscal, right? You say Japan fiscal is awful. Which fiscal are you bullish then? So you got to find something worse than the dollar, right? And it's like, okay, I think Europe is worse. Canadian, I'm not sure. I could see, I'm still bullish LATAM. I'm kind of a broken record on this, although I do worry about the Brazil. The election is gonna, I think Lula wins it, so that's gonna kind of delay the case. But I still long term, I remain bullish. But that won't matter for the dollar index. That really doesn't matter, right? Dollar index is basically euro and a little bit of yen. So I think if I were to take a guess, I think the euro depreciates more than the yen appreciates, and anyway, the weighting is such that the dollar index could go up. But I think the right currency trade, and if you allow me a minute, I want to kind of test an idea that I've been toying with. So it seems to me that after the earthquake in Japan, there was this no mass moment on the world where we realized, okay, Japan has suffered too much. Like they've gone nowhere for 25 years. They have now they got this earthquake. We got to help them out. And it was not disinterested help, right? It was also Japan is strategically important. We have bases here. We need them for China. So we kind of allowed the world collectively allowed Japan to run this massive experiment of, you know, whatever it takes to fix the economic issues of Japan, we will do it, and we let them do it.
Okay.
I wonder if we will not be at the same point with Europe in a little bit. Like Europe is the sick man of the world, in the same way that Japan was the sick man of the world in 2012. We are also getting, acts of gods against us. Like, it's hotter in Paris than it is in Dubai. France is burning. The immigration crisis is getting completely out of control. I mean, you can see like a scenario where Europe really goes really bad. And I got to think that no one really wants that.
Right.
Like no one wants Europe to fall. Like you could see a scenario where the euro breaks up, and that would be a major source of problem. So I wonder if we will not get to the same point. Like, okay, Japan, you had your time, you fixed your issue. Thank you very much. Now we help out Europe and we allow the euro. Like the Europeans, okay, you don't have tech. You have to pay super high energy costs. Your Chinese market is like the only thing that can save you is, a euro less than one against the dollar for extended period of time until you can sort your problems out. So that's kind of my secular currency idea, that we need to give the Europeans a break, because if we don't, they will implode. Whichever way means a weaker euro.
That's fascinating. I like it. All right. You mentioned LATAM and you said that you're a broken record, but why don't you break the record one more time with us and give us the bullish case? Because I really think that if we were to get an AI correction, it will be an opportunity for investors to go find something that's not tech related, and that LATAM would be a very obvious beneficiary of a collapse in the AI bubble.
Yeah, spot on. I mean, that's, there's Mercado Libre, which is kind of a Argentinian Amazon, but that's the really only serious tech name in Latam. I mean, otherwise it's your BBC, right? Beer, bank, cement, very commodities, value, tangible asset heavy indices. And yeah, I mean, one thing like that, for example, Europe is suffering from this China shock, right? Where, suddenly we see like car imports through the roof. Anything that Germany does, China does 10 times better for 10 times cheaper. Yeah. For Latam, that's positive because there is no there's no Argentinian car, there is no Colombian tool machine, right? I mean, so for them it's all wonderful. They get it for cheap, makes them more productive. Now Europe and the US are putting trade barriers and tariffs, so they are sinking their own competitiveness, while Latam has a positive competitiveness shock from all these Chinese capital goods that are flowing in. You also have the Chinese investment that have been going on for a long time. You see this giant port in Peru, and now the Americans are waking up to it, and like, oh wow, if we want to keep these guys in our camp, which I don't know if they can. Like at this point, if you're Peru, if you're Chile, like it's really, you do like more than 50% of your trade with China. I mean, it's gonna cost you. Like you can't just like, invite them at, golf parties or whatever. You have to give them stuff. And you saw them already do that with Argentina. Like there's a reason why Besson bailed out Argentina, even though, worst mistake in the world, repeatedly. It's because if we want to keep them, like that Donroe doctrine, we have to pay. We can't just be the kind of this abusive bully that just takes stuff from them. So that's the geopolitical angle. As you know, both you and I are quite bullish commodities. So, I mean, you have the copper in Chile and Argentina, in Peru. You have Brazil has everything. Colombia has a lot of oil. Now Venezuela is in play too. And then you have the politics, right? I mean, with the possible exception of Brazil, you have this wave of pro-market. So, it started with Bukele in El Salvador. Then we just had the Colombian election, Chile with Katz, Peru with Fujimori, and of course, Argentina with Milei. Now, I don't think these guys are as great as they are portrayed, but, it's certainly better than the alternative. So, yeah, everything's lining up. Yields are still very elevated. You got 6-7% real yield on Brazilian tips. So yeah, I would ride out the volatility and keep overweighting the region.
One of the things in my groups, I always have to sit around and listen to them like do their inside baseball stuff in terms of the Brazilian election. And it just feels like they're looking too close and that they might miss the bull market. I was wondering if you feel the same way. And why don't you give us the inside baseball just for those who are interested and give us your opinion about the election? And does it really matter?
So one Brazilian hedge fund manager told me, I'm gonna butcher it, but the quote was something like, "Brazilian socialists are like your friends' kids. From a distance, it looks adorable, but if you have to live with them, it's hell." So, um, yeah, I mean, I'm with you on this. Okay, but you need maybe get Paulo or some other Brazilian guys on to take the other side. My view is Lula. We had this is his third like he's not a new it's his third term. He's the biggest bull market in Brazilian equities was the first two Lula terms. You don't suddenly become like a communist dictator at age 84, whatever is going to be. Plus, the Brazilian politics are so messed up anyway that nothing really changes. There's this insane like checks and balances, and you add in the corruption in there. I mean, no one can do anything anyway. So even if you have the guy you want, he can't do it, and the guy you don't want, he can't do anything either. And in the meantime, just look at the farming output of Minas Gerais, or like some of the provinces. Look at the oil output, and that's what matters. So that would be my take on it.
Okay.
But I don't know if you have the counter argument. The counter argument.
I don't. They sit around and they're very much like they're passing around polling and all this stuff, and I'm like, I don't think it's going to matter. And the other thing about it is, if you're a big investment manager, like I remember watching Michael Sembelis from JP Morgan talking about buying South America, and he can only buy Brazil. Like he can't even buy any of the other countries because they're not big enough. So the reality is that if your secular theme is going to work, Vincent, they're got to buy Brazil.
Yeah, 100%.
Yeah, like it's like I remember when people got bullish on uranium and they were buying all these crappy little stocks, and I was like, Fidelity can only buy Cameco, so Cameco's gonna go. Like that was it. Like they can only buy the biggest of the big, and so therefore in a true bull market, the big stuff goes first, not the little stuff. That's my feeling.
Yeah, I mean, if you're like it's like a LATAM equity long short fund, like one popular trade, for example, was the Colombian oil company Ecopetrol against Petrobras. That was one way to express a bullish view on the continent without and acknowledging the excess level of political risk in Brazil. But for most people, just buy ILF and you're like I don't know what it is, but ILF is probably like 60% Brazil, 25% Mexico. So,
yeah. Okay, so you go around and you talk to a lot of different clients. What's the mood like out there, and what surprises you when you get the questions and you learn their positioning and where they're at right now?
What surprised me, honestly, is how well they know the rest of the world. If I talk to like a portfolio manager at a Chilean insurer, he can have a very sophisticated conversation about Kevin Walsh and Kashkari and the inside politics of the Fed. And I wonder if I had the same conversation in the US. Could they even name anyone beside Lagarde? And I do think that's, I don't want to do the whole ugly American thing, but that to me is a major weakness about the U.S. And you see that, for example, in the way the Iranian conflict played out. I think by virtue of us being the world hegemon, everybody, and being somewhat open society, everybody knows more about us than we know about them, and I think that creates all sorts of biases and risks.
Oh wow. And do you think that that's an opportunity? Like I'm shocked at the willingness of people to stuff their money into an overpriced currency in an overpriced stock market that is the highest concentration that it's ever been. And I get it, it's working. Completely understand. So it's been the right trade. But as it becomes more and more overpriced and more concentrated, it just seems to get more and more scary to me.
Yeah, I would agree with you. I mean, I see the risks really building in the U.S. stock market, and yeah, I see all the that on the boat, right? It's everybody's on the same side of like, okay, you got to be in the U.S., you got to have the AI story, the capex, and if any of these things turn out to be missing, like for example, if going back to this whole Brazil story, right? I mean, if Brazil growth disappoints and Lula is elected, I mean, it's not the end of the world. Like, people will, it'll be a bad quarter or so, but then you'll go back, right? I mean, if the whole AI thing blows,
Yeah.
that's really bad. So just from a risk management perspective, I have to agree with you.
All right. What is the thing that keeps you up at night the most? Like what is the market? What risk is the market underappreciating?
And long term, it's got to be inflation. I mean, if there is only one, I think it's still going to be inflation. I think the now we had a couple good PPI, CPI. You see like CPI swaps have come down quite a bit. Break evens have come down. I understand it for the next year. I wouldn't bet against it, but yeah, 5-10 years. I mean that one good CPI report changed nothing about the next 10 years, and I still think we are in this environment of it's like if you can think about a pendulum, right? A pendulum just usually every move is less strong than the other one, and I think the pendulum in the US is swinging with harder and harder, and we are still in this escalatory dynamic, whether it's in Iran, whether it's with Russia. I think that the US politics are getting increasingly violent, increasingly Latam-like, between clash of the populists, that we will have a left-wing populist takeover of the US in 2028, and the market is really not pricing any of that stuff.
Actually, I did not expect that answer, Vincent. So good for you for catching me off guard. By that measure and this pendulum that you're talking about, so you're saying that we could have very much like the 70s when we had the dip and then we went back up. Like we could have new highs in inflation in the coming years.
Yeah, that's my. I mean, inflation is. And I spent a lot of time on this. I mean, I looked at it in Europe, I looked at it in Latam, I looked at it in the UK. I mean, inflation is a process, not an event, and it's a process that plays out in waves, right? And again, just recent memory in the US that everybody knows, right? Inflation picks up during World War II. There's a first peak, there's a second peak after the Korean War, and then there's a third peak in the early 50s. Then move back to the 70s. There's the first peak after the dollar shock. Then there's another one in the middle 70s, and then there's the big one in 1979. So you get these three waves. I mean, the same thing if you look at Brazil in the 80s, or it's kind of like these at least three waves with a 5-year kind of pattern, a sine curve with like a 5-year gap in between. We are at the 5-year anniversary of the first spike, 2021. I do expect, maybe we solved it. Maybe we capitulate to the Iranians. All the old product moves and it falls. But it's what I keep saying whenever I'm being asked about inflation. It's a very frustrating answer, but I think it's the only correct one. Is I don't know what's going to cause the next wave of inflation, but I know the next shock is going to be inflationary. Like there's going to be something that's going to come. I can't tell you what, but because of the way the political system is, the institutions are, events in themselves are not inflationary, right? I mean, you could have made the case that COVID was deflationary. It was deflationary for China. it was inflationary because we had this insane policy response, right? And so and these conditions are still there. So you don't know what the next shock is, but you know what the effect is going to be. And I really, there could be a multitude of things. Like I'm worried about the El Nino thing. Like, it could be like, you look at the temperature anomaly in the East Pacific Ocean. It's never seen. It's 7 degrees hotter than usual. Like when I was in Peru, I was swimming, like surfing without a wetsuit. It never happens. That means that we're gonna have like massive flooding in Latam, massive drought in East Asia, Europe. We had all these fires in the summer. Like we could have another shock to agricultural prices next year, and we still have these fertilizer issues that are lingering. So you know what I'm saying? Like I don't want to sound like the catastrophic guy, but there's no shortage of things that could.
I have found somebody that is structurally more bullish on inflation than me, because I like we're both kind of looking for a cyclical downturn in inflation, but you're scaring me on the other side, and you're making a lot of sense. I tend to agree with you. But wow, that's a great note to end it on. Now, listen, before we end, I've asked you all the questions that we've had over the time. So let's talk a little bit about your trip to Japan, because more and more people are traveling there. And you were there with what, teenage boys? Can I ask?
Mm-hmm. Yeah, 8 and 11.
Yeah. So tell us what the highlights were. If anyone's thinking about doing this trip, would you recommend it? What would you make sure you hit, and what would you avoid? Give us the whole kind of Vincent Deluard's guide to Japan.
I mean, the whole thing was awesome. I think if I had to pick one, I mean, we hiked Mount Fuji, so that's a serious mountain. And my little.
So how long does that take? Is that like a multi-day affair?
2 days, yeah.
Okay, so you sleep halfway up or something?
Yeah, which is really cool. Like you stay in a little hut, and they do all the cute Japanese things, and everything is spotless. And no, it was so that was definitely awesome. Yeah, two thoughts maybe. Trying to generalize from my experience, I think I can share 2 thoughts on that. The first one is that the magnitude of the tourism boom in Japan is something that's kind of part of my case for the stronger yen.
Right.
Now, Japan, there was no foreign tourists in Japan for long 20 years ago, almost no one. Now, tourism is Japan's second largest export, almost on a par to cars. And again, going back to this idea of Europe versus Japan. So Japan is also getting hit by the China EV car shock, right? But as the car production declines, the tourism is picking up, right?
Right.
Europe is not in the same boat. If things continue, within 5 years, there will be more foreigners visiting Japan than the US. And I mean,
wow.
the two curve are incredible. Like for the US, like the number of tourism has plateaued and is actually coming down. And I think that's the price we pay for being kind of, big bullies. Like we're pissing off a lot of people, while the Japanese are doing the other around. So I think that's becoming a structural competitive advantage, and it changes the trade dynamics and all that. So that was the first idea. And the second one is I thought it was interesting to look at Japan from the lenses of my 11-year-old and my 8-year-old. And for them, they are utterly convinced that, everything's better in East Asia, basically. Like the way they view Japan, China, and Korea is the same way I viewed the US growing up as a child in France in the 80s, where it's like, oh, wow, they have the new Nintendo there. Everything is better. And this is weird because I'm not with Vincent, who's, our common friend, who's like, kind of, and for the right reason, but he's always talking about Asia, right? I never talk about Asia. I don't make them watch anime. I don't have like it's just popular culture has convinced them that, but like they don't even doubt it. Like for them, the technologically advanced, I have to tell them, no, the US is still richer. Like this is like I mean, I can't explain GDP to them, but like most Chinese people are like live on way less money than you do, kids. But no, they are entirely convinced that everything's better in Asia. And I think it's a generational thing.
Okay. Thank you very much for your time. Why don't you tell people where they can find more about you and your great service and your great firm?
Thank you. Yeah, I work for StoneX, which is a Fortune 100, almost $20 billion market cap these days. Stock has done
Nice.
very well. Yeah, yeah, yeah.
Yeah.
Congrats to the executive team there. So the easiest way is if you're a client already, just reach out to your broker and say, hey, I want Vincent stuff, and we'll figure it out. If not, my Twitter handle, X handle is at Vincent, Vincent, Deluard, Deluard, at Vincent Deluard. There's a pin tweet where you can subscribe for a free trial. We give them out to everybody. Reach out in your DM if you're looking for a specific report, having a conversation. I spend less time on X because of all this AI slop these days, but I try to spend more time interacting with actual intelligent people. So I will still do that. And then, you can reach out by email, vincent.deluard@stonex.com.
Yeah, and if you're an institution, make sure you hit him up on the Bloomberg. He is there. Vincent, it is always a pleasure having you on the show. Thank you very much for your time, buddy.
Thank you, Kevin. Bye.
All right, Patrick, time for talking charts. Lots happening, actually.
A lot is happening. Let's talk about the S&P 500 and the market. So now, me and you recorded on Thursday the 30th, July 30th, a day where we had this bullish engulfing candle come in on the S&P. So we have not talked at all about this explosive S&P move on the upside. And it's, again, super interesting from my interpretation, and you can certainly tell me whether you feel the same, but what's happened more and more is that options have become a bigger and bigger player on the field. And when markets are not asymmetric, increasingly traders reach for out of the money calls or even at the money calls as a way to get participation on the upside. And when that explosive move happened, I was reading one of the, I think it was Charlie McElligott or something, but the implieds on the dailies were basically so underpriced that dealers had to reach for extraordinary amounts of hedging, as they were basically mispriced, and they were the fuel that really sparked that additional marginal buyer that really kind of literally, let's call it a crash to the upside, because that's what it pretty much almost was. It had all of the characteristics of what happened on the way down, but it happened on the way up. We saw we saw to the 100th percentile the steepness of the call skew occur, like where they literally steepen the right tail. Like, that's very uncommon to see on the S&P during that move. How did you see it? Or you have any?
Yeah, so I noticed the same thing. You had lots of days where the more violent it was to the upside, usually you get selling of VIX and a decline in VIX as we go up into new strikes and the people sell calls against it. Instead, what we were seeing was VIX was positively correlated to the stock market. We would get the stock market rallying all day, and it was like VIX was going up with it. Oftentimes, that's a bad sign and shows that we're near the end of the rally, but it doesn't. Like, all these rules and kind of old relationships seem to be breaking down. In hindsight, Patrick, I think that it's pretty clear that the Leopold stop out was more pushing markets around, and that was the real problem. And once we clean that up, it was all clear for the bull market to resume.
Well, and come on, when Citadel picks up, $5 to $10 billion of assets at a discount, it's only proper that they get to unload it a week later at a 5%.
Everyone gain. Says that.
No, that's a joke. But
I know, no. But like, that is a common refrain. I would be surprised if Citadel was in that trade for that long afterwards. I still contend that most of the kind of the behavior that you saw from that trade was in the pressuring the stocks down into the print. And that was really where we saw the weakness. And then it was just a matter of, instead of them, holding it and being able to sell into the rally, because the rally, you would think that if they were long all this inventory, that the rally would have been like hampered on the way up afterwards. But to me, it almost feels like once you cleaned up the seller, there was no more sellers left. Yeah. So I really kind of interpreted the opposite of most people, where they think that they made all their money by being long afterwards. I feel like that they probably made just as much, if not more, by being short into it or by pushing it down into the level. And I suspect they're long gone. And I also, listen, it probably wasn't just Citadel. There's a lot of other people. Like, everyone would have known that trade. I'm sure that if you're in the know on Wall Street during that period, everyone knew he was in trouble and where they were pushing it down lower.
So, okay, well, we agree. So let's talk about here and now. So since that squeeze higher, we've gotten a weak jobs number, inflation numbers that are coming in soft, and overall the stock market was trade until today's little pop, and we're recording this Thursday afternoon. Beyond that little pop, we've had a market that for a week has stayed in an incredibly tight range. It was almost inactive during this 5 days right here in the middle. And to me is price acceptance. This could have been a classic prairie dog. When you have that kind of a squeeze to the upside, there could have been price rejection at that upper level. Sellers would have hammered straight into the strength, and it would have faded all the way back, and we would have been talking prairie dogs all day long. But it actually broke out, and they accepted the new fair value up at the upper level, and the sellers have not even begun to retrace in any form that advance on the upside. To me, no matter how on a macro scale one can be bearish, saying the AI bubbles burst and we've turned the tide on a number of different metrics, but on a tactical short-term basis, as in let's say a 1 month basis, this broke bullishly, and the bulls have a very strong cushion, a safety net, where like we would need a greater than a 400 S&P point drop to trigger CTAs or systematic selling. There would need to be to reverse the primary trend, to do anything at this moment. So long as all dips are bought within 100 S&P point pullbacks, then we could end up seeing this being the story of the rest of the summer. Like we could be at Labor Day and we could be at 8,000 on the S&P. So that we have to separate the time frames of a macro thesis versus the short-term technical reality, which is no matter how bearish one can be in the long term, on the short term, the bulls prevailed and they're in control. They got the possession of the ball. They're the ones making the drive, and the bears have been broken, and they're scrambling and routed. And so until they can regroup, there's right now you have to respect that the bulls are in control. At this moment, the question really becomes what will drive a bull continuation, because this impulse shockingly was driven by Mag 7s.
Yeah.
There was an explosive move on the Amazons of the world that shot higher. So, but the question is, can the Mag 7s continue to do the lifting? Because the semiconductor bubbles burst and they look like dog shit. I don't care if they're up today. This chart is brutal on these semis. Where do I have it here? Like the semis, the S&P's at all-time highs, and the semis have not even been able to a 50% retrace of their prior drop. And some of the individual semis look like shit. You know what it reminds me a lot of?
What's that?
I was waiting for the ask.
I'm sorry, I'm a little slow today, by the way, because I had my market huddle meetup. We'll talk about that afterwards, but not my market huddle meetup, my macro tourist meetup. Sorry.
Okay, so you're a little bit hungover.
Yes, I'm a little bit rough this morning.
Okay, so this is very reminiscent of 2000. I'm not the first person to say this, but I want to actually give context to this. More importantly, I think that the poster child for this is actually the Kospi. So
okay.
What I want to do is I'm going to put on a weekly chart on the NDX, and I want to go and have a quick peek at the bubble, right? And so the NASDAQ, when it peaked back in the dot-com bubble, we had a 40% drop that happened about 2 months.
Okay.
And then you had a dead cat bounce rally that was a staggering 40% rally that took 3 months.
And as you point out, you lose 40%, you rally 40%, you're still well off the highs.
So this, when we take a look at, for instance, the Kospi, which I continue to think is the kind of epicenter of the bubble in that manner, we had not a 40%, but a 44% rout on the downside. And it took only 42 days, not 2 months. And at this moment, over the course of 3 months, there's nothing stopping the Kospi from going to 7,500 up 40%, or even 8,000 going up 49% off of there. But it is very likely that the Kospi and the AI story can mimic the NASDAQ in the post-peak period, where everyone over the next couple of months will be making lots of money and say, oh shit, in the last 2 months, the Kospi and semis are up 10, 15, 20%. But structurally, they've already pivoted into a bear market. And this is the thing to watch, because the next couple of months leading into conveniently the midterms, where, if you want to look at a scenario where, there's those people out there saying, oh, they're not going to let the market crash before the midterms kind of crowd. I'm not necessarily in that perspective, but it's certainly from a time frame perspective fits, because if we have a 2 to 3 month period where that little mini crash that we had in there is mean reverting, and we're seeing these flags and wedges happening, it's a period where everything could be stable and calm in there, and it could all roll over in the late October, November period, and we could be in a scenario where everything is shitting the bed all over again for Christmas. This is sort of a timeline that I'm debating.
Yeah, you get no pushback from me. And I think that there's a very good argument to be made that the midterms are going to have some political fireworks, and the market's underappreciating the dangers from that perspective. I will agree as well with you about the summer. We rallied, we seem to go sideways. That's tough to argue is really bearish. I guess maybe where I'll push back a little bit is I could see absolutely nothing happening over the next couple of weeks. I think that yesterday or Tuesday was the second slowest day of the year so far. It wouldn't shock me if we just end up being, 2 weeks of nothing here in terms of going into the end of August, and traders are just frustrated and thinking to themselves, geez, I should have headed to the beach.
So Kev,
that's what's it's increasingly
is a 1 month 2% rally in the S&P meet your criteria for nothing?
Yeah, I don't think that's going to happen. I think it's more likely that it's just that 2 weeks from now, when we're doing this again, that we're exactly where we are right now.
So it wouldn't change my thesis if your scenario played out. But for my starting scenario, I still am looking at for it to be more like a rising wedge where pullbacks are bought, little pokes to higher highs can happen. And really, to your point, is that we might be very well trading at the same price where we're currently today, a month or two from now. But I think there will be trips to higher prices along the way in this kind of a rising wedge formation.
Yeah,
And so,
but we talked about the fact that people are reaching for outside calls because they're so excited about it. And I suspect that reach for upside calls will be disappointed.
And it's funny because a lot of people are talking about they're shocked by the low VIX. First of all, at a 14 handle, first of all, I want to highlight that there is a long history of summer doldrums on the volatility indexes trading near lows during August, simply because there are many occasions where the summer literally just becomes boring, and you're not going to have a volatility premium that is reflecting an active market when there's two windows, usually during Christmas and during August is the kind of typical periods where volatility tends to revert to kind of doldrum levels. And I don't think reading into a 14 VIX handle here, it has to be put in context of the fact that it is August 14th in the middle.
14 isn't that low. Like we've been
August
8. Like we've been at truly stupid.
Well, on a daily VIX, like if you look at daily VIX, you got your 8 handle on VIX on a 1 day vol basis. I mean, that's right along 1 year lows for daily volatility. So that's already manifested.
Yeah, but we've been on 8 for 30-day VIX before in the summer.
Yeah,
and to me,
not 8, 12.
Really?
We've been at 12.
Well, we've been at realized of sub
realized,
okay.
Realized, yes, but not.
Okay, let me just. I thought we'd gone down to 8. Maybe I'm wrong. One of the things though, Patrick, that I will look, and I'm agreeing with you here, is that if you think about the potential, like what could have derailed it, what could have made an exciting August? To me, two things could have made that. We could have had a CPI that put the Fed in a box, like increase the pressure. We didn't. We had a CPI basically on the screws.
I should save that conversation because I want to move to
no. Okay,
but
okay, we'll talk about that. But then the other thing that could have like made things exciting this August was earnings disappointing, and they haven't. They've meet/beat. Yeah. So the reality is that between the two big macro drivers that would have added some excitement to this summer, both of them have come up, duds. So it's not surprising that we're just, meandering around and it's boring. And I suspect that's what will continue. Now, the fact that you and I are both saying this means, folks, you should be going out and buying VIX because something bad's going to happen. But yeah, I guess I'm looking.
Well, VIX is very low because it's only 30 days forward, and realistically, between now and the September expiration, especially with the fact Labor Day comes in, what is it, the 7th or what is?
It's late, yeah.
Labor Day is the 7th of September. So you're 1 month forward. The 14th of September is 1 week after Labor Day. So the likelihood that the next 30-day window is summer doldrums is very high.
Okay. Yeah. Patrick, can you pull up VIX in 05 to 07? And then it did the same in 16 and 17. We've been down sub 10s.
Yeah.
Given how low correlation is,
you're talking about these two little dips down to 8.
Yeah. And then we've been down there.
Yeah,
05 into the last, there was
I see it was 07.
Yeah. Sorry. Into 05 to 07. The whole period was super low.
Yeah. Anyway, I'm a seller that we're going that low, but
14
but the point I want to talk about 14 to me is just reflecting the time we're in. Why should we have 18 to 20 vol in August? Now let's move on for a moment.
Okay.
I want to specifically talk about my current market call. If this market is going to clear 8,000 and have one more leg higher, which I actually am more sympathetic to than you. You're clearly much more in the camp that's thinking. I'm in that. For me, it's a simple call. Will we see a few of the key Mag 7s turn up off of key levels? Let me start with Apple. Apple had an earnings miss, gap down, but has more or less held into what we would define as a Fibonacci retracement. If in the coming weeks, Apple breaks back and above its 50-day moving average and turns back up, at the same time, take Google, which has been, had a huge earnings miss, extraordinary comeback in the post earnings miss window, and has also retraced down into fib zones. The point here is if the Mag 7s are bought on dip and they all go through one more impulse higher, the index ain't staying flat. And I think your flat scenario is where the Mag 7s tread, where they just grind into a spin wheels in a mud, not necessarily bearish, but simply are not contributing. Under that scenario, semiconductors are already stuck. And so if Mag 7s get stuck, there's just nothing that's going to take the index higher. There isn't enough breadth in the market. And so I think that whether you're right or I'm right is going to be determined very quickly as to whether or not the Mag 7s participate. If they fail at these levels and these big behemoth hyperscalers are not participating, this index ain't going nowhere.
Okay. And I'm fine with that. And I actually do think that they all going to fail and they're going to be choppy. And every time you turn around, somebody's issuing more stock, right? Like
I'm giving them the benefit of the doubt. So I actually, we have just slightly tilted thing. We agree on the outcomes if certain scenarios happen, but you obviously are just thinking one's getting more likely than the other. Actually, before we talk commodities, let's talk interest rates. And let's talk about what happened with the Fed. So let's first rewind here and talk about the non-farm payroll coming at minus 23,000 on Friday. And it was the kind of first kind of blow to the hawk thesis, because obviously a weak jobs numbers, it's very hard for the FOMC to feel that they need to tighten conditions, right? And that was the first kind of little blow to the hawkish positioning. That followed up with yesterday and today, we got the inflation numbers. And while CPI literally came in line with expectations, tick by tick to the forecasts, we had a weak PPI. The main PPI came in flat versus 20 forecast was 20 basis points, and we had core PPI come in at 20 basis points versus 30 basis point thing. So inflation is clearly not responsive, even in spite of tight diesel markets and all these other types of variables that are in there. We're not seeing it translate into inflation that is more or less running away. So I'm going to let you comment on all of this together. I'm just going to set this all up. But what we really saw, which I thought was super interesting, was we were seeing a much greater probability than not on the Fed funds futures that the Fed was going to move in September. And literally since Friday till today's PPI numbers, the stir traders are walking back the probabilities of a Fed move here in September, now giving a 65%, so 2/3 odds that they don't move here in September because of these weaker numbers. And we saw that with the uptick in the silver futures. They've all kind of turned a little bit. But the part that makes me really interested about this, and this is where I want you to take over and run with it for a little bit. The next meeting, if they don't move here in September, the next meeting is the 28th of October. which is a week before the elections.
Yeah.
And my opinion is, unless the next month numbers are so hot that the Fed can't ignore them, I feel that it's much more likely that the Fed will have to take the knee in October as well, in terms of not not risk being politicized in that manner. To me, the September, I thought it was last month, but to me, the September window, if they're going to raise, it was that they were going to raise here in September, because then the only alternative after that is to really raise at Christmas in the middle of December. And so right now, the market is pricing in for year end, the belly of the curve at one rate hike at a 45% odds. But the shape of this distribution has massively pivoted. We had a fat right tail, which is that the odds of 2 rate hikes a month ago was like 30+%. And the odds of them staying unchanged was down 20%. But now we're talking a 1 in 3 odds that there's no rate hike at all this year. And the majority is that maybe they might raise once. So the market has suddenly become in the camp that it's a one and done. Now, the weak numbers, all of this, go for it. Macro tourist man, give us the.
Well, first of all, I know somebody. There's going to be a real stir trader in there that's going to say that you are talking about the projected path as opposed to the distribution. So I just wanted to say that's not you misspoke a little bit, because to figure out the distribution, we'd have to go look at the options and to see how they've changed that, because even though the projected path might be doing that, the distribution might be changing. But in terms of that projected path, I agree with you. I can't see them doing an October 28th hike. Like, it'd have to be inflation just screaming, employment, tightening up, meaning that the employment rate is going straight down and everyone making money. Like, it would have to be something extraordinary in my mind for them to tighten. Like, what is it? 5 days ahead of the election, or 3 plus 3, 6 days before the election. They're just not going to do it. Like, so I agree. And I even think that it's difficult for them to tighten in September. And this was part of the reason that I thought if you were going to do it, you should have done it last meeting.
Month. Yeah.
Because even September, I think that is extraordinarily close and could be viewed as trying to change the election. And that's why I really did think they were going to go last time. Given that everything's headed the right way, Patrick, in terms of for the Fed, it sure seems to me that the most likely outcome is that they just stay on hold now. Right? They had the chance to hike. If they wanted to hike, they would have done it.
That's not what the market's pricing in, but I personally am in this camp. Yeah. I'm in agreement with you, but right now,
but it's headed that way. So yes, the market is still pricing in a hike, but Patrick, since we've last spoken, they've priced in less hikes.
Yes.
And that's the point, right? Yeah, I have to, and I'm just looking, I pulled up the 1-year inflation swap to see what's happening there, because that is the market betting on where inflation's going over the next year. And that's not, that has nothing to do with Fed funds. That's just folks betting on the inflation rate. And that thing is, it was 3% at the beginning of June, and now it's 191. And we did have an uptick in July, and now we're almost back on the lows. So the market is telling you that inflation's not really a worry. And given that, if the market's telling you that the inflation's not really a worry, given the fact that we're so close to the midterms, it sure seems to me that the Fed has time to just wait and see. And that in reality, it will be the people that said, I don't think that Warsh wants to hike. He's not as hawkish as he made himself out to be. In hindsight, that was probably correct, right? That he was talking more of a game in terms of pretending to be hawkish than he's probably going to end up being.
I think he positioned himself to be hawkish, And if the data was continued to be hot, I feel he would have been hawkish. I generally think he positioned himself, but he made himself that, well, look, we're going to be flexible and we're going to adapt to the unfolding reality and the data as it comes. And what's clear is the data is coming, like, since his initial kind of inauguration and coming in, we had the AI semiconductors peak out.
Yep.
We had generally inflation coming off. Oil had the big June decline, and even though it's normalized a little bit since then, overall, a lot of the things where he came in, listen, we're ready to fight. Things are like, well, maybe there's no one to fight. He point is I don't think he did a show. I feel like he went in and said, we're ready to fight, but we need the data to prove that we need to fight. And it's not.
Yeah. Listen, whether he meant to do that, whether he was trying to force the long end to at first people were saying he's trying to force the long end to go down in yield because he was trying to flatten the curve. Then people were arguing, no, he's letting the long end do the heavy lifting for him. Everyone's got all these theories about it. I happen to believe that he's still just one person in terms of on a committee, and he has to deal with the committee, and the committee is going to do what the committee wants to do. I don't think he can bully it around as much as people think. And on the whole, I suspect that the market has paid way too much attention to what he said, and we should just kind of think about what the committee wants to do. And it's I had a good buddy that really smart guy convinced me. He's like, this is still kind of the Powell FOMC in terms of the committee members, and it's not that much different. And if you take out what Borsch is saying in terms of waving around all these different theories and ideas, the reality is the committee is going to do what the committee wants to do. And if Powell was FOMC, this is probably where we would have been anyways, right? Like he would have been in the wait and see mode. And the only thing that's changed really is that we got a little bit of excitement in terms of for a little bit that we had more of a chance of a hike priced in. And in fact, it seems to be Warsh wants to interject some volatility into it. And he was successful in that. But I at the end of the day, I think, Patrick, we're back to the Fed's going to do what the economy makes them do. And to your point, the reality is that we've had the conditions ease for them, not ease or make it less so they could be more dovish. And that's what they're doing.
All right. So I want you with top of your head.
Yeah.
I'm going to ask you
my
for
big
a
bald
probability.
Head. Yeah.
Throw a probability. What is the probability that you assign that when we're looking here at the December 2027 SOFR that we saw the bottom?
Okay, so you're asking
just
me
numbers. Like, what's the probability that there's a bottom?
That on the December contract?
December 2027. We're going out to end of next year.
Okay, I got to look at the curve exactly. 1 second.
No, I said at the top of that bald head, and then you're looking at the curve. You're trying to calculate. I want the.
I think there's a good chance that I am more bearish on the economy than most, so I have to take the increased chance that that's the bottom, because I suspect the economy is more precariously perched than most market. I would probably be on the more bearish side in terms of the economy.
Which is bullish to SOFR.
Which is bullish to SOFR because if the economy rolls over
25, 1/3, 2/3. We're just having fun.
Yeah. I'd give it at least a 2/3 chance that was the bottom.
So now let's go through the next step.
Yeah.
What would you envision a fantasy scenario where this is clearly a wrong thesis? What would have to, you can't just say inflation going up, because something would have to be driving that inflation higher. Like, what is it that would have to be the unfolding reality for this thesis to be crushed on the spot and the SOFRs go for another leg down?
Okay, that's a great question. From 1982 all the way to 2020, the markets were, or 2020 is wrong, probably 2008, the GFC. The Federal Reserve tried to influence the economy by changing interest rates. And they changed interest rates to try to encourage private sector borrowing. And that was how they influenced the economy. In 2008, we hit the zero bound and they could no longer encourage private sector borrowing. And so therefore, eventually they tried all these extraordinary monetary means, but those didn't work because the reality is that if there's nobody to borrow money, then you can try all you want trying to shove it into the system, but it doesn't create it. And then in 2020, the market figured out, or the governments figured out, fiscal spending. And so we had fiscal spending. And since then, everyone has just been focused on fiscal spending and thinking that that's the only game in town. We went from just focusing on lending money into existence, which is what happened from 1982 all the way to 2008. And then we started to figure out fiscal, which is the government spending money into existence, and we became focused on that. You asked me what would make me anticipate higher rates in the future. In essence, this private sector lending money to existence continues at a fierce pace. And we are seeing some pickup in private lending in terms of banks lending it into money, into existence. And what would occur is if I misjudge that ability for the private sector to create money, and therefore if that continued, and it would probably be a
monetary inflation is what you're saying.
Yeah, and it's like,
not supply shock inflation, but monetary. So you're not saying oil going to 100. You're saying
no, because because I feel like oil going to 100 will be actually eventually deflationary for the economy, because it will stifle the economy and cause it to eventually go lower. So to me, what I would be worried about is that I am incorrect in terms of my downbeat, dour look on the economy, and that the AI boom, expands into the general boom in the economy that encourages people to go out and buy houses and to take loans and do all the things that we used to do in terms of creating money through it being lent into existence. Yeah. So that would be what I would say. Or I don't think this would happen. And I do wonder, even if it did happen, how the market would react, or we go back to running massive deficits. I just don't see that happening. That's not a very realistic option, right? And in fact, when we talk about like the one big beautiful bill, we are going to go from all of this stimulus being front loaded to encourage, to help the Republicans win as many votes as they can in the midterm. On the other side of the midterms, a lot of these one big beautiful bill kind of expansionary policies that we've experiencing will go and flip the other way. Okay. So I don't see us being in a situation where the government is spending the money into existence, and where I would be wrong is if I misjudge the private sector's willingness to lend money into existence.
Awesome. Okay. Long bond. I want to, it's been the chart of death. Yields up to 5.25, beta highs. But one of the most interesting things that I wanted to observe and keep talking about, and this is just at the cotsignal.com, looking at the commitment of trader reports.
Which is, by the way, is free. Everyone should go check it out. cotsignal.com.
Come check it out. Yeah, it's completely free. But the interesting thing is that the 2-year note by large specs is in the 100th percentile of positioning. While
long or short?
The 2-year.
Yeah, but long or short?
The 100th percentile.
Oh, you talk about it as percentiles. So you're saying that the long.
They're on the long end, right?
Okay.
It's crowded.
Okay.
Versus the 10-year being at the 0 percentile and the 30-year at the 16th percentile. Basically,
everyone's got the steepener on.
Yeah. And so what's interesting about this is how we got here. And so you can see the 2-year still net positioning is short as a percentage of open interest. It's just massively reversed. But almost all of it is not because there's a huge amount of gross longs adding new positions, but rather over the last, let's say, 3 months has been a huge short covering from gross shorts. So obviously, I would assume a lot of this is hedging contracts on large spec. I'm not sure that there was necessarily people betting too aggressively on the short side, but we were down like 2,200,000 contracts net short back in April. And we are now at a situation where the net shorts are about 1.6 million. Yeah, so we've seen a substantial like 600,000 contracts of gross short being covered. Rather, longs barely moved. In other words, we had this positioning shift in the net contracts, but not because everyone is speculating on the upside, but rather everyone that was short is covering. And that's interesting because I would conclude from that their asymmetry of being short or protected on the downside of the 2-year is dissipated as the Fed path is probably almost done, like we've talked about earlier. And so my conclusion on this from a positioning perspective is that no one feels they need to be hedged or short the 2-year anymore. And they're basically covering. But what's interesting is when you get to like the 30-year, the short positioning continues to build. Everyone is leaning into being short the 30-year. And to the point that all year we have just seen them adding more and more short contracts on the 30-year bond, to the point that on a 5-year look back, only in the middle of last year in 2025 or late 2024, early 2025, did we have more net short positioning on the long bond than we do today. And so the interesting part is that there's been a lot of people betting on the long bond going down, and they've been rewarded. They've been rewarded because it's been getting its face ripped off. But the interesting part there is, will this lead to a short squeeze? Like, will there be a point where everyone is so consensus short the long bond? Because it's like literally you guys can all hold hands and sing Kumbaya, all the long bond bears, because there's literally no a long bond bull is few and far between, including, by the way, Lacey Hunt has gone short bond. So like maybe that's the bottom.
By the way, like, you know, like the famous what's the you never go full whatever, you're not allowed
you never go
you never go full flip, because the reality is, and I know this all too well, if you're like a big bull and then you go, I'm giving up, I'm flattening my position, and then you go short, you're just like asking for it. Like, that's the worst utter thing to do. Like, because the reality is that if you were bullish and you're wrong, you're not thinking clearly. You're not, approaching it with a nice, open mind. By the way, I just want to push back a little bit, Patrick. You say like all the bond bears have made so much money. And one of the things that just kind of frustrates me about this is that you can tell that folks that are really trading and the people are just talking about charts, because like they'll like, look, the yield is at all-time highs. And then you go out and you look at the total return. And I just pulled up the total return of the long bond future. And I'm actually shocked. You could have bought it at the lows in 2023 and still be up money. And part of the reason is,
we're talking tactically the move that has happened in this year, right? Tactically, we went from 119 to 109 in less than a year. You're not is somebody that's been short the long bond this year is making money.
For sure is making money, but it's not as good as it seems. And that's my point, is that
holding a high yielding asset short over the long term has a carry. I understand.
Right? Like it's just kind of all these guys that loved long bond at 1 and didn't understand that the reality is that when you had a 1% coupon, it didn't cost you very much to be short the thing. versus
Okay.
now at 5 and all.
Let's be clear.
Yeah.
That the short interest in gross short interest was back in January, at the start of January, 56,000 contracts on the 13th of January. Now the gross shorts at their peak were 420,000. So you had short sellers this year, in this calendar year, not these long-term bears when the cost to carry and all this shit that you're factoring has almost tripled from January 13th.
Okay, and I completely agree. And that's what everyone's been highlighting is that the CTAs are short. We're the most short we've been in a long, long time. Your question was, are we going to get a rip the other way in terms of do they get squeezed? I think they do. I think that's a very good chance. I'm sitting around hoping for a kind of, what do you call it? Your turtle head formation. Yes. I'm hoping for like a big puke. And the fact that I'm hoping for that so that I can buy it almost leads me to believe it won't happen. That it'll just all of a sudden start rallying out of nowhere and catch everyone off guard. Now, having said that, Patrick, I think part of the reason that this is such a crappy looking chart is because the hyperscalers just keep issuing and issuing. And that is the part and that's back to my thing about the private sector doing some crazy stuff. The private sector is borrowing and expanding, credit in a big way. And that's the part that I'm having trouble reconciling. Besson can go and pull back on the duration that he's going to issue here and try to get the long end behaving better. But the reality is that the hyperscalers, they don't care. And they're the ones that are the marginal extra seller that is causing the long end to weaken. And as long as they're doing that, like, did you see that CNBC roundtable or whatever?
No.
Where like all those guys, by the way, Chanos had the greatest comment. He said, like, the next time these guys all get together, it's going to be in front of Congress. That was a hilarious comment. But they're just like, what was it? $500 billion? $500 billion. Like, I was just laughing like, oh yeah, sure. Why not? Why not $500 billion? Like, just come up with a number. Let's go for it. And we're in just this silly season in terms of them issuing. And one of the things that really worries me, Patrick, is that if you're sitting there and you're experiencing your option adjusted spread widening, meaning that they're costing more to borrow. Like if all of a sudden you're going from an 8 to a 9, you might think that usually that would cause them to borrow less. But the reality is they think that they're earning 25 on it. So it might not be a situation where even as the market makes it more expensive for them to borrow, that they slow down their borrowing. Yeah. And that is ultimately what I'm grappling with in the bond market is that this massive, creation of duration through all these hyperscalers is weighing on the bond market. And it's a difficult thing. Ironically, Patrick, if we have a situation where the AI trade rolls over and people don't want to lend to these guys anymore, that would be the greatest thing for the long end.
Yeah.
Anyway, so what do you think?
Let's
are you
move
bullish?
on.
Are you Let's are you bullish?
I'm not tactically bullish yet. I believe that the shorts continue to be rewarded on the short term. And like, for instance, a TLT, I wouldn't be shocked if we got another 2 points down to 80 or something. At some point, there's going to be a bottom, and it's such a crowded short that there's going to be a violent move the other way. But I'm not saying that it's happening this summer. Like, okay. It might be a September, October story. It might happen after the September FOMC or some trigger like this. I'm not positioning now for that move.
And here's the question on everyone's mind. Did you take down the Lacey Hunt posters from your bedroom?
I did now. Shh. Don't tell anyone. No. So.
Yeah. And, oh God, you just want to rub it in. You rub it in that I was kind of somewhat bullish bonds. And now you're going to rub it in with the yen.
Well, listen, we did our episode recording last week.
Yeah. And
this was just as raw on the tape as it could possibly get at the time when we were recording on the 30th. And obviously the intervention came in like a storm.
Yeah.
Like they just came in. What was it? 100 billion that they
I don't know.
Some number like this.
I missed. It was a lot of money, and then it was like that whole thing with Besson posting the Post-it note, letting everyone read it. Did you see that?
No.
Oh, so he was at some sort of meeting, and he left in front of his where he's sitting. He made it so that the reporter could take a picture, and it was literally, it says like buy Japanese yen, like, it was like 5 to 10 billion or something. It was I don't know what the number was. It was something like that. But he leaked it. He like Ice Cage. He knew what he was doing.
He knew what he was doing.
Yeah.
So what was interesting is actually it was incredibly supported by crowded positioning. So this rip we saw going into the meeting, going back to the COT report that basically was issued 2 days before the intervention. So it was released on Tuesday the 28th. And we saw at that moment a 5-year gross short positioning extreme on yen futures.
Oh, okay.
And so obviously it's a bigger market, but it gives a sentiment view of how broadly people were positioned. But what's crazy is the intervention created a 118,000 contract swing in a week, where the net position went from 163,000 to 45,000 contracts from a net short perspective, literally in a week flipped. It was one of the largest COT report swings of positioning that I've seen. It was huge. And obviously the intervention was the gas, like they lit it, but they lit it at a time when everyone was leaning short the yen. And then they scrambled like chickens with their heads cut off to cover their shit. And that added the additional velocity to the burst. And so now that happened. But now what's the interesting part is, did it start a feedback mechanism that is now a new yen rally, or will it be a deja vu of all the intervention attempts all year long that ended up just immediately fading right after they intervene? Now, I'm not making a forecast, but I'm just saying we're about to find out.
Yeah. And listen, absent them doing anything, you have to almost go with that, right? Like the reality is that if they're just going to waste some bullets, and not really change anything, then it's not going to accomplish anything. That it's not going to work. You have to either raise rates, which I would be less likely.
The numbers came in, but correct me if I'm wrong, but the inflation numbers in Japan came in hot. Speculation is that they're going to raise.
Yeah, but they have to raise rates faster than the market thinks they have to raising rates to affect the price of the yen, right?
Yes,
like they have to.
You're right.
They have to, like, you have.
It's the path has been priced,
yeah. And the reality is that whatever they're stupidly easy right now. I don't think rates are as important as the GPIF. Like, I would be more inclined to change the investment policy than instead of doing the rates. That's just me. But absent them doing one or both of those things, then the yen's just going to continue to weaken. And what's that line? The definition of insanity is doing the same thing and expecting a different outcome. Someone should tell the Bank of Japan that.
So I am going to make a tactical call here.
Okay. Bring it on.
Tactical call is very simple. We have now retraced 50% of the rise.
Okay.
Which is in trading terms is an incredibly common thing. Even Dow theory or anything, you have the primary impulse and the secondary corrective retracement of the prior move. This is like basic kind of perspective. So we're at the inflection point. If this was a meaningful turn, and in fact, the yen is in a new trend move. We should see it start being bought in the vicinity of this area right here, and it should happen soon, as in the next week or two. And if that holds, I will be in the camp that the yen is going higher, but I need to see the level hold first. I'm not making my move preemptively. I'm being reactively. You maybe even have to pay a little bit of a higher price, but I want to see whether the bulls can defend the line. On the US dollar yen, it's easier to quote. That's about the 160 level. Basically, so long as it stays below 160 throughout the next week or so and rolls over, I think you can short the US dollar yen for another move. But that level has to thing. If we're north of 160, then my entire thesis is dead. I'm gone. Not interested. You won't catch me there. But this is an interesting moment that I'm watching this.
Okay, from your lips to God's ears, or to the
All right.
BOJ's ears.
Let's talk commodities for a moment.
Okay.
Crude oil, first of all, looks like it's found a new fair value zone. What was clear on the way down in June was there was a very large amount of speculators long on the $120 oil or $150 oil thesis. And they all got squeezed. They all got washed out. They all got margin called. It got cleaned out in June, and it was a bloodbath. Oil overshot completely to the downside. No business being there beyond Leopolding everyone on the downside of oil.
Okay.
And now oil bounced higher. You have a situation where once again, we were 1 day away for the 40th time in 4 months from a peace deal. And once again, it was a nothing burger. And you have an Iranian administration that continues to hardball because they know, think about it from a game theory perspective, the elections are several months away. They're holding the cards. Why would they be the one to compromise pre-election? They know that if the situation is very bad going into the election, that it hurts the existing administration that is basically attacking them. The point I want to highlight is that there's no reason for a peace deal to happen quickly.
Okay.
There is, and so the idea that oil's heading back to retest 65, while the probability is never zero, I would call that the outlier scenario. There would have to be a substantial building of longs, and they would need to get squeezed. But the crazy part is, in spite of oil going from $70 back to 90 and settling at higher levels, there has been no meaningful rebuild of long positioning, the COT reports. Basically, everyone is sick of this trade. Nobody wants to deal with Trump tweets anymore.
Yeah.
And no matter what the situation is fundamentally about oil, everyone's been broken. And so that to me actually is supportive, because in order to wash oil back down to 65, you would have to have someone to wash out. And there's no rebuilding of longs, so there's no one that's there to be washed out of the position. And so I actually think we found a fair value zone. The way I would put it is that this, over the pre-war period, this kind of $60 to $70 area was the fair value zone. Now, with a tight oil markets driven by a Strait of Hormuz that continues to be constrained, probably 80 to 90 is probably going to be the new higher shelf, the area where generally prices will kind of gravitate above, below. And if conditions get really bad, it could obviously shoot. But I think that this is one of the drivers behind a lot of energy stock rallying, because it's the acceptance that we ain't going back to the unprofitable $60 oil, and that there's actually profits to be made at these higher levels. Any comments?
No, I will kind of echo from a fundamental basis what Paul Sankey highlighted the other day. And for those who don't know, he's an independent energy analyst. And he said that there's indications that China, when oil slips back below 80 into the $70 range, they start refilling their SPR. And then when it goes back up to the $90 or $100 level, they ease back on their filling of their SPRs. So they're in essence creating this new band, right? And it was interesting to hear you come up with the same numbers from a technical perspective that Paul is highlighting from a fundamental perspective.
Smart minds think alike.
Yeah,
just different ways. Anyway, let's talk gold.
Okay.
I know you did a macro tourist right up on the gold miners.
By the way, all of my readers were like, "You're stealing a page from Patrick's book." And they were like, "I didn't know you actually, chewed crayons as well." They gave me, multiple good natured ribbing about the fact that I was doing something from a technical basis. So tell me. From a technical basis, was I correct?
You're getting smarter and smarter every day. It's this is the first tactical meaningful turn in gold since the violent March retracement that was from a crash sequence on the downside of gold. We have not seen enough time pass to know whether this is still the start of a new trend move. What I'm fearful of, listen, I'm actually bullish, and I don't want to sound bearish. I'm just fearful of.
Okay.
There is a lot of people that love gold and silver.
You think?
And I remember back in May of this year, when silver made this breakout move right over here on all technical basis, the amount of people on every social media platform and newsletter thing claiming that the new silver bull market has begun blew my mind. I immediately was like, how can so many people know like thing? And look how it faded back then. Now, I'm not calling for this to happen now. But what I do want to stress is I am shocked by how consensus it is that this is now already the turn in gold. There is a very large amount of outspoken people that have made this. Now, if I was a pain trade, and let's make a pain trade thesis. The pain trade thesis is, how can the market fuck over the maximum amount of people in this? There's a lot of people that have leaned heavily into the fact that this is that major turn point.
See, I disagree. I don't know who you're talking. I think that's your
I'm just
crowd
talking about my feeds and people that are coming on the.
I think that that's more among your gold crowd.
Sure.
And I think that, of course, the gold crowd is trying to buy every dip and trying to come up with bullish reasons.
Okay.
So I won't push back and argue that they're skeptical, because they're not. They are very excited about this, and they do think it's turned. Having said that, when I think about more of like just a macro community and like just traders in general, I don't see the same sort of excitement that you see. I don't. I
appreciate that insight, because
I
live in a bubble.
I think you do.
You're
So now, having said that, I did have my macro tourist meet up, and everyone was long gold. So, but I think that was just because it was in Canada and it was skewed to my crew. But I just don't see it, Patrick. I don't see it.
Let's look at this two ways. Number one, we had a 2-year bull market that ripped to the upside, right? And that rally on the upside was essentially a 3,800 point rally. Let's round it to 4,000 for the purposes of keeping round numbers.
Okay.
We had a 2-year $4,000 run, and more or less we had a 6-month 1,700. Let's round it to $2,000 pullback. We literally gave back half of the prior gain.
Okay.
Right. So from a market perspective, that is actually, again, a 50% retracement. It literally is the market advances in primary trend 2 steps forward and takes 1 step back during corrections and gives back half the gain. So from an asymmetric perspective, we are far closer to a buying opportunity than we were to the top.
Okay.
This is already things. So when we look at this far enough out, those are the buyers that are buying and forgetting about this for the next 2-3 years, then everything we're about to talk about is just noise. This is this pullback is a tactical entry, not tactical. It is a long-term entry point because we gave back half of the prior rally. It just is a good spot to take long-term positioning in gold. Now, so that being the first base, the question is, how is it going to play out tactically? Which is all these traders that are piling in on the first breakout above the 50-day moving average. It is not uncommon for the market to shame everyone with a pain trade, which is just like everyone gets too ambitious too quickly. They need to resolve who's the strong hands and who are the weak hands that can be shaken out of the trade. And I simply won't rule out that even though this is a long-term level to buy, that it's going to potentially challenge investors at least once in their resolve to hold through this bottom. And this is where I would not be shocked if we had the infamous turtle head formation sneak in here for one.
Oh, you think it's going back to even below the lows?
I'm not
there.
saying I think.
Oh.
I say I would not be shocked.
Oh, I would be shocked.
I would not be shocked. And I'm in the camp that I would not be shocked. So the way I would tell you this, Kev, is I am long. I am not short. I am not bearish. I am bullish and I'm long, but I'm hedged. I feel that you need, once a primary bull trend is underway, you can remain unhedged and just let it go. You have big profits protecting you, a primary trend that's well established. You can stay unhedged and lean into it. But the place where you want the hedge is always at the starting point, which is where you don't know whether or not the first inning of the game has actually really started or not. And so in my mind here, I'm optimistic, I'm long, but I feel that it would not shock me if the market did some sort of a retracement to shake everyone, that it takes September and October to sort out the lows before the really big money is made.
Oh, listen, you could actually be correct. I guess my pushback would be
that
you're applying you're applying traditional market behavior. And I would argue that even if you look at that 50-day for that whole bull run, it was shockingly unbelievable how it never really dipped below it in any meaningful way. Okay.
And by the way, that would be the actual really good re-entry point is that as it retraces back to the 50-day, if you see the bulls defending that line very well, like they have done in the past, I would use that as confirmation evidence that the transition to the bull phase has actually happened. But I feel that it is, I would rather say that it will take all of the next month into middle of September, if not early October, to genuinely establish enough price action to say a new bull market is underway. Okay. This is the first shot of a potential breakout. And long as traders don't allow themselves to be shaken out on short-term noise, there's probably really big money to be made over the next year in gold.
Yeah. So I just wanted to say though, Patrick, I think since 2022, the gold market has changed, and that this is all a function of People's Bank of China and other central banks accumulating gold. And that in essence, what we experienced was the Western buyers starting to sense that and get involved in that, and that China walked away, and then we had Turkey selling, and it got a little complicated. And if I'm thinking
China's
about it, I'm thinking China's back, and
They did 20. They did like what 20 million ounces or something. No, not million ounces.
And I just
200 tons or something.
And
20 tons.
I hear what you're saying about this, and you very well could be correct. And maybe China, walks away again and lets it sag and actually lets a turtle head, like you say, and then comes back. But to me, the bigger risk is that we just continue to walk upwards as even everyone is bearish and worried about it. And I guess this is why I feel a little more comfortable with this. You see everyone around you being bullish. I see lots of skepticism and people not thinking that gold is somewhere to be. The reality is, like, stop and think about us, in late 2025, how everyone was long gold and excited about it. All those, degens are gone. They're all trading, semiconductor stocks, right? We haven't had that back, that same sort of excitement come back.
But you know what? We're talking about the way the price action behaves at the starting point, not end game.
But I'm just saying that I think that the People's Bank of China is going to change the behavior of this, and you're applying rules that are based upon
that's gold. But the Bank of China does not buy GDX. It's not buying gold miners, and you're basically betting that somehow. If China does not allow gold to dip below 4,200, that the GDX can't go through a volatile swing. Anyway, both of our points are made. What I want, I'm looking at the time. We've run pretty hot. I want to ask you a simple question.
Sure.
What's the one thing I forgot to talk about on this chart? What is it that we have to look at that I did not mention that we should that we should talk about on the show?
On this chart or the show?
On a chart. On like, what chart should I pull up? Like, what is it that we need? Or even the topic that I forgot to mention. What should we think?
So we talked US dollar, we talked gold, we talked bonds, we talked stocks,
oil.
We talk to oil. I don't know. You got something in mind? Is this a...
No, it's not. I just wanted to see if I forgot something big.
Yeah.
I'll do quickly. How about this? Lightning round quickly through the grains and softs.
Well, I was going to say, if there's anything we should talk about, it's those. Yeah.
Look at this. A retrace back to the 50-day moving average in wheat. It'll be very interesting to see because look, corn, big breakout attempt, soybean turning back up. Are we going to see the grains run? Next thing, look at this chart rebuilding bullishly on cocoa. Cocoa went through a 3-year bear market. Now we're seeing the commitment of trader reports starting to rebuild long positions, short covering. Things are turning. Is this going to be the turnaround point in cocoa? Sugar made a huge breakout. Again, another 3-year bear market in sugar from 2024 down to 2026. It's been a vicious murder in this market, a halving of the commodity, and a big breakout in happening in sugar on the upside. And even coffee is attempting to turn things back. The American breakfaster is going to be very upset.
Could we have an agricultural bull market that creates like actually inflation from that perspective?
Yeah, but still supply shock inflation. But yes, the answer is yes.
Yep.
We definitely can. We have breakouts right across the board in foods. And if it's not just a small little move, but rather a sustained new trend, it's going to trickle in 100%. That's it. That's all I got, buddy.
Okay, great. Good job, Patrick.
Good job, Kev.
Patrick, where can they find more about you and your great calls and your wonderful community?
Right off the bat, just get over there to thecotsignal.com, completely free, no strings attached. You can check out all these amazing commitment of trade reports and all these things we were talking about. And follow my YouTube channel where basically Patrick Serezna, you can see me these daily updates rather than you having to wait every 2 weeks for a huddle session. That's but Kev, where can they find you?
They go to Macro Tours and listen. Bull market, bear market. We're just happy to spend some time on this crazy ride. So thanks for tuning in, and we'll see you in a couple of weeks. Now stick around for the after show.
All right, Danny, jump on here.
So Patrick, I just want to tell you. Well, you do your beer first. We gotta stay true to this.
At first, it's was caramelized and like had a much stronger taste than I was expecting, but it grew on me very quickly. And as I got to the halfway part of the bottle, I was like, oh my God, this is actually pretty good. So it was interesting. It was one of those scenarios where it was an unfamiliar taste. So you're like, ooh, what is this? And then it grows on you. And so like what I would have rated at the first sip versus what I'm rating it at the end are two different things. But I will say that I'm not saying this is great. I would give it a 7.4. It's a good.
I'm calling bullshit on that you tasted any beer and claimed it was an unfamiliar taste. But there we go, 7.4. But I just wanted to, take a moment, Patrick, and let you know. So I had Macro Tourist meetup, just a little one. It ended up being a little bigger than I thought, but it was just
you look hungover.
I am feeling a little rough. It was wonderful. It was terrific. Everyone was so nice. It was a lot of fun. We ended up at an Irish pub. It was great. It was terrific fun. But
why would you expect to be anywhere else?
Yeah. I want to say though, Patrick, the number of folks that said, I really thought Patrick was going to show up. I really wish Patrick was here. And lots of folks, the guys from, one of the guys from Barrie that had come in from like all of these things, like a lot of folks that have been with us for many years, they were all there and they were all asking for you. So I just want you to know you are missed.
I in November and December, I'm going to make some appearances in Toronto. So if you wanted to do a little gathering, I can do your share of drinking since you're lightweight. So, what was really cool? So Danny and I are out here in Portugal, and the interesting right here in this part of Europe, we just had the solar eclipse.
Yeah, Danny was telling me earlier.
Yeah, and there's some phenomenal footage online. Like I just went blind. I didn't see.
I was gonna say, I know Danny's smart enough not to look straight into the sun.
No,
but I thought you were gonna pull a Trump and just stare at it with your eyes.
And I've ruined my eyes. Like,
that's okay.
Let me just get my glasses on. But I can't see anymore, so it ruined everything. No, but bottom line though, the images online were amazing. Like just some of these solar eclipse images were so beautiful, and I thought it was so cool. Danny, you got a couple of shots, didn't you? He's like, can't.
He's muted. Danny, you're muted, buddy.
Oh, what a rookie mistake!
Yeah, that was going to say amateur hour.
So I'm up in northern Portugal, and I managed. It was super cool. Like, it's kind of eerie. Your brain doesn't really understand what's going on, and then it kind of everything goes dark very slowly. And then I caught just the moment that it had passed through, and it was just on this mountaintop, so you could just sort of see the top. And I managed to catch one image of it. But yeah, it was pretty dope. I thought it was pretty cool.
Dope. It was dope.
It was dope.
All right. Everyone, have a great couple of weeks. We'll see you all. Take care. Thanks for tuning in.
Cheers, everyone.
Take care.
Cheers, everyone.
Bye-bye.